Okay, this is Unit 2, Week 3, Video B, talking about nonprofit activities that are forbidden for nonprofit companies. The outcomes to discuss how to avoid violating legal restrictions for nonprofit organizations, special attention giving to political lobbying and advocacy, as well as political activities, and we will again talk about private inurement. This material comes from the NOLO publication of Nonprofit Tax Guide, pages 380 to 410. So, is lobbying and advocacy legal for a nonprofit? Yes, it is, but within certain guidelines. What is the difference between lobbying and advocacy? Well, lobbying is one type of advocacy. Lobbying consists of efforts to influence legislation, either at the federal, state, or local level. Lobbying is very controlled for a nonprofit. Advocacy is completely allowed by the IRS. A nonprofit may seek to change or implement administrative actions of administrative agencies and to appeal executive orders. So lobbying is dealing with the legislative process of passing laws. Advocacy is dealing with the administrative agencies and appealing the non-legislative laws, but which may be executive orders. So lobbying and advocacy by individuals, that's okay if you are a officer or even the CEO. You have the right to lobby and advocate as much as you want on a private basis. Only official acts of the organization are attributed to a nonprofit organization. So if you're out speaking, you speak as the individual, not speaking as the chairman or the president, or not speaking for the nonprofit organization. There's such thing called self-defense lobbying that is allowed, that a nonprofit may protect itself from legislation that may be affecting that specific nonprofit organization. This occurs relatively rarely. And then nonpartisan education is not lobbying. Nonprofits are allowed to educate the public, or legislator is not lobbying if done in a non-partisan, generic manner. That means universities, churches, organizations like that may have political activities that are neutral. We'll talk a little bit more about that in a few minutes. So, how much lobbying is too much? There's two tests that the IRS applies. First is substantial part test. It's used by most nonprofits. It says if the substantial part of its overall activities relate to lobbying, that the nonprofit cannot do that. But it's not clearly defined. In fact, it comes from different cases. It appears by looking at the case decisions that below 5% of the income of a nonprofit for lobbying is okay. Above 16 to 20%, it's substantial and will get the attention of the IRS. The second test is expenditures test, and that's how much money did the nonprofit spend. It's direct and grassroots. The reading has more on that and shows a couple of charts. There's an absolute ban on political activities. That is not lobbying. Lobbying, remember, is looking to affect the legislative actions of bills being passed. But political activities is supporting or opposing a candidate for public office at either the federal, state, or the local level. A nonprofit organization may not participate in political activities. However, it may engage in nonpartisan election-related activities. Those can be get out the vote campaigns, educational debates, and town hall meetings, so long as each that the candidates that are there, the nonprofit is neutral and no candidate is endorsed. Individual directors and officers may engage in political activity, but only in their individual capacity, not representing the nonprofit. The consequences of political activity, the legal form that most companies take are nonprofit corporations, and that corporation can be fined 10% of the cost of each prohibited political expenditure. And managers can also be liable that up to 2.5% to a maximum of $5,000. The most important part, though, is if this becomes too egregious, the organization could lose its tax-exempt status. So if an organization gets too involved in political activities, either lobbying or any kind of promotion of a candidate, the organization will lose its tax exempt status. That means that from the time that event happened, the nonprofit could be taxed on any monies that come in. But even more importantly is that the donors that had written off the donations from previous times, once the nonprofit loses its non-tax status, those donors must go back and file amended tax returns and can no longer take off the donation as a expense from their individual taxes. So it has very serious consequences. So be very careful not to get involved in these types of restricted or forbidden activities. There is a way to get around such restrictions. A nonprofit can form a subsidiary under a 501c4 social welfare organization. As a 501c4, it's a nonprofit, but its donations are not tax deductible by the donor. So it's a nonprofit company, and you've heard of this before when people are asking for donations for certain political causes and things like that. You're not supposed to take those as a tax deduction as a donor. The 501c4 companies may engage in extensive political activity. They may not give money directly to a candidate, but they can form a political action committee, a PAC, and they can do advertising and they can support the candidates or the issues. So that's one thing you just want to be very, very careful of with a nonprofit is getting too involved in any type of lobbying or political activities. Of course, you can't always promote the primary purposes of your nonprofit, but this is getting far afield and beginning to get involved in the legislative process. So one last thing for this video, foundations. A foundation is a private charity usually formed as a corporation, and it's under Section 509 of the Internal Revenue Code. Foundations are highly regulated and special attention is given to several activities. The foundation is usually one funded by one or few sources, such as a corporation like the Ford Foundation, or by individuals, such as the Bill and Melinda Gates Foundation. The IRS watches foundations to make sure that there are no self-dealing provisions taking place, that disqualified persons are not involved in the foundation, that there is a mandatory annual distribution. They cannot just continue to grow and get bigger and bigger. 5% of the fair market value of the foundation's non-charitable assets must be distributed. Limitations on excess business holdings. Foundations may not make jeopardizing investments. To do so may subject the directors to personal liability. And one of the most important characteristics of foundation may not make taxable expenditures without a penalty to the organization and the individuals responsible. So they have to be very careful that they're only giving the expenditures in the non-taxable realm. There's an excise tax on net investment income by a foundation. So, conclusion: be careful what kind of lobbying that you do. Never get involved in political activities supporting a specific candidate, and never allow nonprofit funds to go for personal inurement. So that is all for this week, and hope it goes well with your quiz.